Dear investors and partners, good evening to all of you. My name is Nimesh Mehta, and on behalf of ASK Investment Managers family, I welcome you to this exclusive webinar on Budget 2023 with Mr. Bharat Shah, Executive Director, ASK Group. Today, we have scheduled an hour for this webinar where Bharat Bhai will share his thoughts on 2023 budget in the first 15-20 minutes, and the balance 40 to 45 minutes we will try and answer all the questions. So request each one of you. I'm already seeing some 15-20 questions, but you keep typing your questions. It'll be my responsibility to curate and ask Bharat Bhai on your behalf in the balance hour. So Bharat Bhai, all over to you for your opening thoughts and then Q&A.
In decades of observing budget making exercise in this country, without any hesitation, I can say the budget which went past on 1st of February, I would rank it as the best budget I have so far ever heard in experience. And in all aspects, I would say this budget passes the test, every important test. In terms of basic, the confidence of the budget, in terms of setting the numbers, it is, the numbers are very credible, very judicious, and there is no doctoring, or there is no giving it a twist or a turn. It is, as you see it, straightforward, clean, and very solid. Therefore, budget arithmetic is not only credible and sound, but it is very heartwarming. Second, if you see, in a year when the budget is in the backdrop of the upcoming general elections in 2024, this budget is not tried to pander or tried to address the base quotient by offering freebies and by trying to be populist. On the contrary, it has remained on the path of fiscal consolidation, fiscal prudence. It is exemplary the way this government during the pandemic time, when it was very tempting to give freebies and throw things at people like America, Europe, Japan, China, every other country did it. We did not do that. We worked on the supply side reforms rather than demand side freebies. The problem was not in terms of stimulating demand during the pandemic time. It was addressing gap on the supply side. Therefore, the rest of the world was focused on Keynesian economics of demand stimulation by America writing checks, Europe throwing checks and freebies. Working on the demand side, India actually worked on the supply side economics, and in the style of Joseph Schumpeterian economics. Therefore, the rest of the world was doing Keynesian economics, while in this country we had courage to pursue supply side reforms of Schumpeterian variety. The Austrian famous economist Joseph Schumpeter, basically the idea that he propagated, and very, very intelligent idea of creative destruction, where efficiency, strength, and solidity, rather than path of least resistance and path of freebies and populism, that is what Schumpeter advocated. And I'm glad this government has a lot of intellectual courage to do the right things rather than succumb to the pressure. Third, if you see, even because all budgets are ultimately political statements also. They are not, they are expressed in economic terms, but they reflect the political priorities and political messages. And therefore, no budget exercise is in isolation of the political context. And once again, I'm very delighted that politically it sends a very powerful, intelligent signal that we would do what is right in the long-term interest of the country rather than trying to do something in the short run which may be popular. One example I can give, and it is an example of great political maturity, I would say, is the example of reducing the tax on the highest bracket. Normally, politically, it is tough to roll back a tax which has been put on the highest earners of the country. If you recollect, I think 2 or 3 years back, that highest slab, new slab came, whereby the highest tax rate for the people are earning above 5 crore became 42.84, almost 43%. In this budget, that has been rolled down back to 39%. Now, typically, you would not expect during the election period and during normally in terms of messaging and packaging also, government will be reluctant to kind of withdraw such a measure because politically also what you have done with the rich people, even opposition can't oppose, and therefore having the courage to recognize that this step was not a right step and it came in the way of animal spirit and wealth creation process for a country which still has only $2,300 per capita income, and it is not a country with $40,000 and $50,000 of per capita income that we can have high tax rates of those kind. And therefore, this government displayed enormous courage of conviction to bring it down. I would say that, to my mind, reflects that this government is very confident about its economics. It's very confident about its politics, and it is very confident about its basic conviction that it has to do the right thing, and therefore it has displayed courage to rectify something that they themselves had introduced some 3 years back. Fourth, once again, in terms of at the same time offering succor, offering help to the people. If you look at the tax changes that have been made, these are remarkable ones. Today, before this budget, anybody who made 5 lakh rupee of income basically did not require to pay any tax. With this new budget, somebody earning income up to 7 lakhs will not be required to pay any tax. In a country where per capita income is still about 1,95,000 rupees, which means on an average an individual is earning only 1,95,000 per annum, to have tax exemption limit starting at 7 lakhs is very, very liberal, I would say. It is extremely generous and liberal. In countries like America, even at relatively lower end of the per capita income strata, the taxes begin and they go progressively higher and higher. And therefore, what was 5 lakh, which was a decent amount at which there was no tax liability, has been raised to 7 lakhs. And across the board for all the other players also, there is some tax reduction because the slab rates have been moderated accordingly. And therefore, this government has been mindful that it is providing some kind of a succor and help and aid to the people with the country just having emerged out of the pandemic shadow. Fifthly, the economic and political morality. This government introduced GST, and there was a lot of criticism about GST initially. Now everybody is able to see that GST is probably the biggest revolution which has been ushered in this country in its last 75 years of history. With the GST and its digital capability, we are seeing that the tax collections have improved dramatically. And for the year which is about to get completed in March 23, it will be touching almost about close to 17 to 18 lakh crores. That number stands 5 years back at roughly half the number. And in this 5-year period, 2.5 years have been in pandemic shadow. And therefore, it is remarkable that these particular piece of legislation has come to the help enormously. Similarly, transparency on the direct taxes and the digitization. This has created the space for tax buoyancy to come, whereby corporate tax as well as individual income tax both have gone up sharply. For 9 months in the current year, individual tax has gone up by 27%, while economy in nominal terms probably would expand at about 13.5 to 14%. Corporate tax collection has gone up in the 9 months at 22%. Therefore, both of them have been much higher than the growth of the economy. The reason why I'm mentioning is the government is showing political and economic morality that government has a right to levy the taxes and direct the resources collected in the channel which it thinks socially is the most desirable one. But at the same time, the economic morality of the government is that when it has introduced reforms and it has been responded with improved tax collection, it has been generous in passing back the benefit to the people who are actually paying taxes. And therefore, in the direct income tax, for the year ahead, 38,000 crore of tax amount is foregone by the government. And that too in an election year again, usually which is always where reduction of the income tax is something which is least likely. Either it will be increased or it will be a status quo. And therefore, I would say political, economic morality of this government is extremely high. Then the spend on the capital expenditure. Capital expenditure has been one focus area of the government based on a very sound economic principle that revenue expenditure is merely spent for the period and it doesn't do anything more. And after that spend is over, nothing much is obtained from that. Whether it is bureaucrat salary, whether it is spent on the offices of the government, or the interest and other expenditure that it incurs. But capital expenditure creates future income also. And therefore it creates a wealth. And therefore this government has been very conscious of focusing on raising the quotient of the capital expenditure compared to the revenue expenditure. And in just 3 years' time, only the 4 years back actually, the capital expenditure was 3 lakh crores, which has been raised to 10 lakh crore in this particular year. It's more than 3 times in just about 4 years time period, unprecedented. In my more than 40 odd budgets that I've observed in this country, I've never seen a phase where a government is so relentlessly committed to raising the economic efficiency and committing expenditure to the wealth creation cause rather than populist freebies. Last point I'll make, and we'll have the floor open for question, is the recognition of the financial sector, which was narrated as a priority. And among the seven Saptarishis that finance minister mentioned, financial sector was one of them. My heart is gladdened, not because that was I'm in the finance sector and we are in that field. But if this country is going to grow, which I believe it is going to grow, and this country is sitting at a cusp of one of the best phases ever in its history in terms of the future growth rate and the solidity of that growth rate, durability of that growth rate, where unprecedented wealth will be created over next 10 and 20 and 30 years, the basis being set and erected in these last few years. In when we think about that kind of an outsized economic growth rate of the country, where in nominal terms, country is seeking to grow at about 12, 13% on an ongoing basis for several years, if not a couple of decades, which will be transformational journey. That cannot happen without markets being vibrant, markets being healthy, well regulated, but healthy, animal spirit being unleashed in a genuine way, not in a contrived or a bad way. And all the capital that we need to drive that growth of the economy, market has a central role to play, because market is not only provider of the resources of the capital, but it is also one of the greatest capital efficiency allocators. And through its actions and behavior, market channelize savings and capital into the most value creating areas and deprive capital from the value destroying areas. And therefore, it promotes the capital efficiency of the economy and wealth and income of the people. And therefore, recognizing the role of the market, ensuring that there is healthy regulation, but at the same time promoting it in a free way without diffidence and without artificial kind of restrictions, um, is something which is economically most intelligent thing to do. But in the earlier period, we have rarely seen that being admitted or recognized. And therefore, because the fact that capital markets and the financial sector is not a major political constituency, it has never been given any due accord, while the role that the financial sector and the capital markets can play for the economy, which is aspirational, society, which is growth oriented, and for a deep long-term commitment to that growth that this government has displayed. All of that is possible, smoother, and wealth creating only when markets are well functioning, are respected, regulated. We have seen how Chinese government has been disrespecting capital and abusing the businesses. And we have seen what a kind of tear apart situation has occurred in the Chinese markets over last several years. Therefore, I'm very delighted that this government has a character and confidence to acknowledge and in a year of election put it on the record. So these are some of the key points. There are many other points, but I'll just stop here with a sentence that, in my opinion, undoubtedly in so many budgets that I've seen, I would recognize this as easily the best budget I have seen in the longest time, in terms of the character, in terms of the confidence, in terms of its purity, in terms of its morality, and in terms of its political and economic sense. In every which way I count, I would rate it as one of the best exercises in the longest time.
Thank you, Bharat Bhai, for the optimism on the budget. But just like to share the questions which have been asked have been slightly tough, and I'll go to come up with as a summary for a few things. First things first, they say NBFC and banks are roughly about 20% weightage in your portfolio. You've been owning Bajaj Finance and FinServ for a while, and they haven't done up to its potential. So, what are your thoughts there? It's been at least 5-6 people have mentioned about the NBFC and Bajaj groups. If you can share the.
Our portfolios are more than 20% in the finance sector. So if it is not 20%, actually it is higher in different portfolios, but it is somewhere between 20 to 30% amongst our various portfolios. So it's a sizable exposure and the largest exposure. Secondly, broadly, I'll say on the lenders, opportunity probably is never better than probably today. Balance sheets of the lenders have been cleaned up over last 3 to 4 years, starting from 2018 when ILF's scandal happened. 2019 we saw Yes Bank and Diwan housing scandals occurring, and 2020 pandemic, 21 second round of pandemic. In this 4 years, a dramatic amount of write-offs have occurred. Balance sheets have become cleaner of the lenders. At the same time, a lot of lenders have shored up their net worth by raising capital. In case of the public sector banks, it has been boosted by government injecting more capital. Therefore, balance sheets have become cleaner for the lenders as well as they become stronger in terms of the net worth. On the other hand, if you look at the borrower, and if you look at the corporate sector as a substitute for the borrowers, then again the balance sheet of the corporate sector has never been better than what it is today. To give you an example, debt equity ratio is on March 31, 2020 of the listed corporate segment was about 75 paise of the borrowing to a rupee of the net worth. That number today stands at less than 40 paise. That reflects that in this period, when we passed 2.5 years in pandemic, balance sheets have actually become stronger for the borrowers also. Third, it implies that capital formation therefore should be facilitated because of that. That the borrowers are in a healthy shape, lenders have a capacity to lend, and therefore the two meeting together should help the cause. Fourth is the decline in the cost of capital, and it is one of the biggest structural changes that we brought about. 8 or 9 years back, your home loans were costing you 14 and 15%. Today, your home loans are available at 7.75, 8% or thereabouts. It's a big change. Drop in the cost of capital, and not artificially, but by systemic restructuring and efforts, has a deep impact. It has impact on the profits of the borrowers. The cost goes down. It has impact on the lenders by improving asset quality as well as lending volumes. It has implication for new capital formation because the lower cost of capital facilitates that. And fourthly, it improves the asset values. Any income earning asset value will improve when the cost of capital goes down and vice versa. Therefore, and finally, both on the supply side of capital and on the demand side, we have come a long way with so many innovations and so many new instruments. We should not forget rates are only last 3-year-old stories. green bonds, GSEC bonds being listed, are proposing to be listed on the foreign exchanges, a wide variety of instruments through which capital, both domestic and foreign capital, can flow into the businesses and projects. Therefore, on supply side, we have innovated. On demand side, there have been innovations. And mutuality is the depth of the markets as well as reduced cost of capital. Therefore, these businesses are ideally suited for a long-term superior growth. Bajaj names that have been taken more so in particular. Uh, we've been owning Bajaj Finance for almost 12 years now. Bajaj Finserv for about 11 years. And in these 12 years, this is the first year where Bajaj Finance and Bajaj Finserv in the year of 2022 have made no positive returns, but actually negative returns for the first time. Of course, single digit negative return in this year, but a negative return in 2022. So you are absolutely right. 2022 has not been very kind as far as both the Bajaj twins are concerned. And markets were slightly positive, and therefore the contrast looks bigger. That in a positive market, even though very small positive, both the Bajaj twins have actually posted an inferior performance. That feeling gets heightened because the preceding 11 years have been incredible wealth creation, compounding story, and therefore low return is something that still might have created questions, but a negative return creates even a bigger question. And therefore, the question is a legitimate one. But let me assure you, uh, Bajaj Finance is one of the finest lenders, not just in India, but I would globally benchmark it as one of the highest quality lenders in terms of the ethics, in terms of the conservativeness of the policies. At the same time, aggression not to let go of business, which is opportune and within their compass, and to do a business which is profitable and at capital efficiency, which is highest in the entire finance sector. There is a concept called return on asset in lending business. A return on asset multiplied by leveraging gives you a concept of return on equity. And both of them are key barometers of value creation for a finance business. Bajaj Finance sits at the highest return on asset in the entire finance industry. For 100 rupee lending, on an average, Bajaj Finance on a standalone balance sheet makes 5 rupee 40 paise as a profit. And on a consolidated, when you consolidate their housing finance subsidiary, it makes about, in the last quarter, it made highest in the history of the firm, 4 rupee 85 paise is the profit on 100 rupee of consolidated asset. Compare that with most of the PSU banks, they would be 30 paise, 40 paise, 50 paise, 70 paise. Inferior private banks will be 80, 90 paise or thereabouts. Better private banks would be at 1 rupee 25 paise to 1 rupee 50 paise. And much better private banks are ranging between 1.5 rupee to 1 rupee 80 paise, at most 2 rupees. These this superior capital efficiency facilitates not only higher growth rate, but also greater value creation. When the same growth rate is delivered by two lenders, one at a higher capital efficiency like Bajaj, and the other one with average or inferior capital efficiency, even if both of them grow exactly by the same number in a particular year, value creation is higher for the superior capital efficiency business because that's more sustainable, that's more value creating because it is deeper, and predictable and solid without creating ruptures. Therefore, there can always be some orders when markets may not be kind to even to best of the businesses. But these 2022 being not very kind to Bajaj Finance and Finserv should not have implications for long-term value creation. They recently concluded a 5-year path for the performance of the firm, and their parameters on that key three value creating parameters: growth rate, quality of the asset book, and the capital efficiency. On the capital efficiency, they are looking at raising it higher than what it is today. In the growth rate, they have guided for the continuation of the same growth rate, what they have talked about all these years. And in terms of the quality of the asset book, it is guided at even more conservative and tighter credit quality than even in the past, which already is one of the best in the industry. Therefore, we believe that there may be an odd time, but both of these businesses remain among the best value creators in the markets in general and in their space in particular.
Thank you, Bharat. Since we're in the BFSI sector, I'll just take a question by K. Gopalakrishnan. He mentioned, thank you for this webinar. The budget has been viewed as adverse for the life insurance sector.
Yes.
What are your views on the life insurance stocks? In fact, this sector has never had any positive news in the past many budgets, and we've been holding. So what's your thought? He's asking that.
Well, in insurance sector, basically there are two things in the budget which may potentially impact. One is a very general philosophical point on a longer term basis. Second is more specific. The longer term issue is that government is moving towards less exemption and less tax rates in order to achieve simplification of the tax rate. Therefore, government has created a new roadmap for tax rates, where you can opt for one higher tax rate but with exemptions, and a lower tax rate with no exemption. The idea is that when there are no exemptions and the rates are low, it is fairer for people, simpler also to grasp, and whole computational and judgmental issues involved are materially reduced, and therefore it makes for a very efficient one. The current generation also is more about having more money in their hands rather than putting into necessarily so much more savings as the relatively older generation. Equally, current generation is a two-click kind of a generation. Therefore, a simpler tax method where you don't have any other different sources of income, it is virtually like an autopilot. In 10 minutes, you can finish your tax return, because now they even aggregate the data for you. You just have to say yes, yes, and all matter is over. 2 clicks and the matter is over. Pay the taxes or they are deducted and you're done. And that appeals to them. The government also has been facilitating this path. They have introduced the new path about 2 years back, but not much has happened in terms of transition. And therefore, most of the people have continued to stick to the older regime with more concessions and a higher rate. But I think the changes made this time are very material. And therefore, there is a very good chance that many more people now will find it easier and reasonable and actually economically convenient one for them to transit. When that happens, the concern for some is that insurance, which is part of some of those deductions under Section 80C, of the Income Tax Act, there is a fear that lot of people buy that insurance only for the tax benefit. And therefore, if they move to the new regime, then that ATC may not apply and may not be relevant, and therefore insurance will suffer. Probably 3 or 4 years back, this may have been more true. Today, they are citing that tax is one of the sixth or seventh or eighth reason why people buy insurance. So security is one, the protection, savings angle, for a specific purpose like education, marriage. These reasons come ahead of many other things. And therefore, tax has relatively lost a bit of a vitality. Also, people who are putting relatively smaller sums into that insurance, if they are able to, I mean, person making 6 lakh and 7 lakh and not paying any tax and has a cash flow, it still will make a sense for him to buy that insurance for these other reasons rather than looking forward to it only for the tax reason. Because in any case, he is getting a benefit by the statute, now with the higher amount being facilitated for the reduction. So therefore, the concern has been that will it work against insurance per se over the long term? And on balance, answer looks like it is unlikely to. In the Western world, there is no tax benefit given for any insurance. And the Western world has the biggest insurance industry in the world. And therefore, there is no reason to believe that only that will motivate. Second is more specific, and that is for what are called non-par insurance policies. Non-par insurance policies are those policies where there is a guaranteed benefit given away, given to you over a long period of time. These policies enjoy tax freedom if the yearly insurance premium is maximum up to 10% of the sum assured, and if such a policy is issued, and then there are long-term benefits. Typically, many of them would have 10 to 12 year over which the protectee pays insurance amounts, followed by long period of 20, 25, 30 years when there is a yearly benefit which is passed on. And in the initial 10 to 12-year period, there is a mortality risk also covered. But largely interest of the people at the high-end ticket has been more to earn that return over long period of time. And these policies offer tax-free different rates, but currently they've been yielding almost 6.5 to 7% kind of 30, 35-year IRR tax-free on that policy. And very large sums have been put in behind by some. So individual putting 30 lakh and 40 lakh and 50 lakh per annum for 10 years and 12 years, and then getting income stream for 20, 30 years. There is a class of people who wants that kind of a product where they want long-term income being generated. And if it is tax-free, it makes it very worthwhile. On these policies, government has now imposed if the amount in a year is more than 5 lakh, then there is a taxability. And to that extent, there is a worry that it may affect non-par business of the insurance firms. Non-par business of insurance firms varies from, you can say, 10, 12% to as high as 50% for some firms. And within that 10 to 50% range, the amount of the business which is upwards of 5 lakh rupee annual premium may range from probably 1% to 10% of the insurance premium, and the business profits, or the what is called VNB, value of new business for the insurance firm, may get affected by probably 0.5% to 5-6% on a per annum basis. Therefore, insurance firms will have to find other ways of replacing this. Some of the solutions will be that it probably 5 lakh may be raised to 10 lakhs. So there is a representation. It may or may not happen. We don't know. If that happens, then virtually 97-98% of the policies will be outside the ambit of the tax rate. And some of the other solutions are where they may be carved out of annuities. Annuity plans in any case have been in existence with a higher IRR, but with a greater taxability, full taxability. So there can be similar carve-outs out of these policy and create a parallel solutions. These are popular policies. Third is mean that in a family of 3 or 4, such a policy can be written for 3-4 members. Therefore, it may not be 5 lakhs, but it can be 20 lakhs if there are 4 members. And to that extent, it will virtually take care of almost all the policies, because less than 1% of the policies are where the annual premiums are upwards of 25 lakhs per annum. So to that extent, there has been a bit of a concern. Market prices have reacted. In some cases, there has been a recovery with a greater understanding of this matter. One particular firm relatively is more affected is HDFC Life by this, because they've been at the forefront of higher end ticket and larger business on non-par side, a very profitable business. And but we were on a call with Vibha Padalkar, the CEO of HDFC Life today afternoon, along with the CFO, and they believe in about 18 months time, they will be able to fully transit whatever is the gap created of about 4-5% due to this by their other products and offerings. So all in all, it's a bit of a concern for insurance firms, life insurance firms, but not a whole lot.
This is very, very comforting, Bharat Bhai. As we move from the BFSI to the consumer sector, I read at least 10 or 11 people have written on Patanjali, and I'll read one of the anonymous attendee have his written. We want to believe in the Patanjali story, but the price action is seriously depressing. For a FMCG company, their FMCG segment performance was shocking. Have we got into the right stock? What are your thoughts? And a lot of people have written a lot about management and so on and so forth. Over to you, sir.
Very, very fair question to ask, and I will try to fully answer that. They basically two businesses. One is their earlier edible oil business, where they are the second biggest in the country. Whole edible oil business is growing at the rate of 3 to 4% as an industry. Patanjali, which earlier was a Ruchi Soya and which had these oil business. Also, Patanjali itself brought in its own edible oil business in addition to this firm. This has been about, you can say, closer to, they've been growing at roughly 2 times the growth rate of the industry. Margins in this business are low. They typically range from 3 to 5%, so very, very low margin. And many of the oil seeds, as you know, are imported, palm being one of the at the forefront. And therefore, it depends upon the imported palm to be refined, to be processed, and to be sold as an edible oil. That is a business with low margin, relatively modest growth, but the capital consumption is low. Capital turns in this business are as high as 8 times, 9 times, 10 times. And therefore, return on capital employed is still very healthy at 20%, 22%, 24%, which is very healthy ROC, return on capital employed, to be earned in a business. Then there is a second business which can broadly be described as food and other businesses. It basically consists of three segments. The first segment is the basically Nutrela platform, the health food. The second business is many other food products. So it consists of ghee, it consists of juices where they are strong leaders. It also consists of, the Chawanprash and various other activities. This is a business which is roughly about, no, let me complete the other part and then I'll give the turnover figure. So this is the second part of that food business. The third part of the food business is biscuits, which is still relatively smaller for them, but growing at a rate much faster than the industry. And personally, I can tell you, I've been consumer of at my home almost about 25 to 30 products of Patanjali over last 7, 8 years. And therefore, I have a reasonable degree of affinity and belief about the kind of products and the quality and the standard. This is a business which is relatively low margin, about 5 to 7%, 8% kind of margin. But it's a business with a high growth. And compared to industry, and Patanjali biscuit business will grow probably 2.5 times the growth rate of the industry for a length of time. And the margins also will inch up as the scale becomes larger over a period of time. The last business or fourth business, if you put it within the food or otherwise, is a nutraceutical. That is a new business that they built over last 1.5 years. It's a very high growth business and a very high margin business. And therefore it is one of the star businesses within the group. It is a business where growth rates for several years easily can be 25% or thereabouts, and margins can easily be 25 to 30% or even higher at a greater scale. Therefore, edible oil, which is roughly about 27,000 crore business, smaller margin, ranging from 3 to 5%. The food business, biscuits have 5 to 7%, 8% margin, but a growth rate of almost 15 to 17%. The Nutrela platform, the health business, is a business with 15% strong, solid, long-term growth, with about 15 to 16% very predictable, solid margin. The food business, that is Chawanprash, ghee, juices, has a growth rate 15 to 18%, and the margins are also in the range of about 15 to 18%. And nutraceutical, I already narrated, the growth rate can be 25% plus, and the margins are in the range of actually 25 to 30%. In the last 2 quarters, a peculiar set of circumstances have arisen. In the second quarter, oil business suffered very badly because there was an unprecedented volatility in the entire oil market in the world. I'm talking of edible oil. In a business where margins are 4-5%, raw material prices change by 70-80% in a matter of weeks and months, No player can handle, no matter what you do, you can handle that kind of a volatility. And especially when there is a very long supply chain, because raw material in, for example, in product like palm is imported, edible oil being a low value product and it cannot bear a high transport cost. Therefore, production has to be local. It can't be central production and distribution. Therefore, supply chain becomes more complicated. And if it is imported, it becomes very difficult. Therefore, they suffered very badly in the second quarter in the oil business. Instead of profit, obviously it went into losses. But in that quarter, their food business did exemplarily well. I mean, it did well above what normally it would. In that particular quarter, it did 2,500 crore of turnover in the single quarter, helped by Diwali being pushed up and some amount of splurge people made after the pandemic shadow kind of went behind. And the margins were also unbelievably high at about 24-25% in that quarter. December quarter, the trade and distribution correction happened as was known. Therefore, turnover was relatively modest at about 1570, which was also expected. Margins were to correct because that kind of a push earlier in the earlier quarter had a greater pricing power, and therefore they didn't have to push, and therefore their margins were much better than normal. In this particular period, in order to push the sales, they had to offer more lucrative terms, and therefore it affected the margin. And therefore, in the third quarter, that is December quarter, oil business improved but not fully recovered. From negative, it came up to margin of almost about 2.5%, and it is expected to improve further from here on. While food business margins came down sharply from 24 to almost about half that number. Therefore, these two quarters reflected a kind of a volatility, especially second quarter was unprecedented. But on a longer term basis, it's a very solid business with solid brands. It is riding on three principal propositions: health, Ayurveda, and wellness. And all the three elements are beautifully integrated in their business. Their products are, many of the products are unique. For example, their juices, amla juices or giloy juices and aloe vera juice and many other juices. Some new juices have come up in the market recently. They're outstanding. In terms of product innovation rate, I would rate them as probably the best FMCG company in the country. They've got almost about 1,000 products, and their ability to introduce new products is unmatched. Dabur is 120-year-old firm, and it is also riding on Ayurveda. Dabur today, after 120 years business, is still about 11,000 crore kind of a business. If you see Dabur's December quarter results, their sales are down and profits are also down. And profits are down despite the fact that advertisement expenditure has been badly cut off compared to last year. If you had maintained the same advertisement expense, which is the key expense for a FMCG firm, their profits would have been down by 21-23% actually. Yet that is a result which went through relatively less amount of scrutiny and punishment. Patanjali in these two quarters definitely faced challenges, but they still have shown growth. In the third quarter, if you see, the profits have still grown by 15%, but at operating profit, it has been a flattish one. But they've shown at a net level 270 crore profit net in the third quarter. From here on, oil business margins will rationalize and will move to normalcy unless there is new shock which comes about. We can't predict. Food business will continue to grow at the steady rate of 15 to 20% bracket overall as a category, with a margin ranging from 15 to 17%, somewhere in that bracket. And therefore, business is significantly undervalued even today. We bought it at a much, much lower price, but business is hugely undervalued. I mean, mm, a balance sheet has 3,800 crore of cash, zero borrowing. 3,800 crore of cash on the balance sheet is a serious, large amount. Business would have turnover somewhere in the vicinity of 35, 36,000 crore for the next year. And the profits easily will be somewhere, the operating profits will be upwards of 1,500 to 1,800 crore territory. Market value of the firm today is about 31,000 crore. You remove the cash, it is 27,000 crore. And operating profit, there is no interest in this business. Depreciation also is modest. Therefore, operating profits are like mostly the pre-tax profit. It's about 15 to 1,800 crore profit at operating level for a market value of 28,000.
Just got lost in the story of Patanjali and made feel like buying. Brother, today I was reading through all the
Just 1 second.
Yeah.
Market price is a bit of peculiar thing in last few days. For the simple reason, it is still in trade to trade. Therefore, 100% delivery has to be offered for any buyer, for the seller, and a buyer has to 100% take delivery. Therefore, 100% of the volume is delivery based. It is in trade to trade because any firm which is out of NCLT, till their entire shareholding, they have to bring it down to 74%. Currently, they have 80% holding. So 6% float is to be sold. Once it is done, it will move out of the trade to trade and will become part of the normal market. In the meanwhile, given the way markets have been violent and volatile in last 4-5 days, anybody who has a margin and given as Patanjali shares, or anybody who is a broker who has a margin as shares, or a person, an investor who has Patanjali shares but making losses elsewhere, may seek to sell to get a liquidity. These unusual factors have created a bit of very unusual price behavior in last few days. But in fact, just before this call, we were having a long dialogue with the Patanjali management. Actually, in the afternoon, we had a call with HDFC Life people. Just before this call, we concluded a long call with Patanjali CEO and the CFO. So these price behavior in the market, in our opinion, is not reflective of the merits of the business. Markets also have been agitated and going through its own pain. I think we have to give it a little time and balming. It will find its true value, which in our opinion is much, much higher.
Can I answer?
Yes.
Yeah. So, by the way, about 20% of queries are summing up into these two questions which a client have asked. It's regard to performance. I'll read it as it says. And this is candid to express their emotion. It reads, I am a very young investor with you since the last 15 months, but my portfolio has dipped by close to 10% since inception and reeling at a loss of about 6.5 lakhs. Any guidance or what should I do now? And, how do you think that my recovery will happen? And I'll just say the second one is expresses the emotions of others as well. He writes, ASK IP is a trusted name for so many years. It has been a benchmark for investors to evaluate in the investment returns. But unfortunately, since more than a year, we have had questions to ask about stocks and sectors. How can you address it? And how soon do you think we can see a lost ground and positive?
No, you have all the right to ask questions. We are trustees. And I personally always put myself as a trustee of the money of people more than anybody else. I love this activity and I love this business. As a shareholder, I would be delighted as more and more assets and therefore more profits and more value of the firm. And as a key shareholder, that's where my side of the bread is buttered. But believe me when I'm saying that I do this activity for the love and passion of it. I put myself as the trustee and upholder of the interest of the my investors who have trusted us more than anything else. All the benefits that come from the value of the firm rising and the profits and the wealth and all these are incidental. Really, it is the trusteeship, the passion for investing, the knowledge gratification of investing that drives me. So with that first point, let me, you have all the right to ask that question and feel concerned. I'll answer it in 4 or 5 parts. First, 2022, without any question, is a performance which has been weak compared to the index. It is weak compared to our own past, and it is certainly much weaker than our capability. And therefore, it has been as much a pain, if you believe us, as probably you may be suffering. So there is no question, 2022 results have been not very pleasing to our mind, and they represent a level of hurt to us also. Secondly, that feeling gets heightened because index in the year of 2022 has been slightly positive. Nifty has been up about 3 to 4%. Mid-cap index has been up about, I think, 1.5%. Small cap index is down about, I think, 1 or 2%. And if you take the whole market and adjust for new issues and other things, then the whole market for the year has declined by, earlier I had computed that number, it was about 7%, but there was some error. It is at about close to 5%. So market in entirety actually has eroded by 5% in the last year. But Nifty and the Sensex has gone up by about 3 to 4%. So clearly, when you are underperforming, when the markets are down and you are down a bit more, it is painful, but still you relate to it. When you underperform in a rising market, when markets are going up but you go up less, it is still painful, but you still understand because it will happen. This one is only second year of this kind in 21-year journey of our PMAs, where index is positive and our portfolios are negative. And therefore the contrast looks higher. And I fully understand why you must be feeling the pain, whether as a young investor or otherwise. But if you have come in these 12 or 15 months, I can fully appreciate that you have not probably experienced the best side of ASK so far. And you've seen relatively more difficulty with you. So I have my full comprehension on that. There is no denying. Third, let me put conceptually 4 ideas. There are things that have done well in the market, but we did not have, and therefore index got impacted positively, but we did not benefit. Then there are things that we have in the portfolios and they have been hurt very badly, exceptionally badly. So there are 4 or 5 names where we have suffered and taken a lot of blow actually in the year of 2022. Then there are some names where businesses have done very well. Businesses have done well for all our investments in general. But despite businesses doing very well, these stocks have not performed or given negative returns in the year. Bajaj Finance, Bajaj Finserv are the examples of that. That both have done very well in their core business. One of the best years has been 2022 for Bajaj Finance in terms of core characteristics. But unfortunately, in the market returns, it has been negative, some 6% or 7% negative for 2022. Then there is a fourth category of the names which have posted positive returns. Some of them have posted positive returns lower than the index, that means less than 4%. And there are many others which have posted higher returns than the 4%, including some having done healthy double digit. One stock in particular have delivered even closer to 3-digit return in the year. Now, in the first category, names which have performed in the market. PSUs have done well. PSU banks in particular have done exceptionally well. Commodity stocks, infra stocks have done exceptionally well. Then there have been metal, ferrous, non-ferrous, which have done remarkably well. And Adani Group shares have done extremely well in 2022. In fact, entire performance of the Nifty, more than 100% of that return is accounted for by just that single group in 2022. And to that extent, that number has been very significantly influenced by limited number of businesses. I'm talking of Sensex and Nifty. Now, philosophically, we believe and we think PSU businesses, PSU banks, many of the metal and commodity businesses are basically trades and not investments. They suffer from inferior economic efficiency. They suffer from typically inferior managements as well. They also suffer from unpredictable business economics. And the past record, if you see, for example, if you look at barring the year of 2022, for the 8 year preceding 2022, entire PSU index itself is negative for 8 years. If you take PSU banks and take a 10-year period before 2022, only one bank posted positive returns, single digit, small number, SBI. If you take 15-year period prior to 22, only two banks, SBI and BOB, with positive returns. In the metal space, while 2022 and 21 part have been very good for metal companies, Tata Steel, Vedant, Hindalco, in the 15-year prior to that, they posted negative returns. And in the 15-year prior period, only JSW has a small positive return. Therefore, these businesses are tough. You have to get them, you have to get into them at a good old and precise time. And you have to get out again at a good old and perfect price. If you stay into them longer than these precise timing, then all that you get is a misery and elongation of time, but not returns. So barring the sweet limited window when you get in at a right time, get out at a right time, there is a very severe winter before and there is a severe winter thereafter. It's only that small window which offers you returns. And you need a lot of luck, not just enough skills to be able to do it repeatedly, where you get in exactly right and get out exactly right and keep doing it time after time over a period of time. That's not our philosophy. That's not our strategy. Because we don't see them as long-term compounding, value-creating businesses. These are trades and limited duration trades, and therefore we have remained away. And therefore, we have not benefited by very popular segment of the market in 2022, which a lot of PSUs have gone up by 50, 100, 200%. Some of the commodity stocks have delivered healthy 40, 50% returns, and we've been deprived. Then there has been second category, many names. 4 or 5 in particular: Tata Consultancy, Metropolis Healthcare, Divi's Laboratory, Sona BLW. These, I'm forgetting one more name. There are 5 names which have hurt us tremendously. All of these businesses are cash rich, good balance sheet, healthy return on capital employed, very good management, long pathway for growth, and kind of management where there is a illustrious record of value creation over a long period of time. These businesses also share one common characteristic. In the year of 2021, each of their businesses benefited from COVID and pandemic. They got extra business, lower cost, and their profits were exceptional in 2021. Markets also responded and prices also went exceptionally high, much more than they deserve. 2022, pandemic receded. The limited period benefit went away from the profit account, and therefore their business performance relatively suffered compared to market, compared to 2021. Some of them posted positive results still. TCS grew compared to 21. Sona BLW grew compared to 21. Metropolis did not. And Divis did not. Both posted single-digit negative growth in 2022 compared to 2021. But like in the year 21, when profits were exceptional, prices were exceptional, in 2022, profits became normalized and look inferior compared to 21. But the punishment on the price has been severe and huge. So even a name like Tata Consultancy lost 37% in a year like 2022. Rarely you come across something like that. So these 4 or 5 names have done huge amount of damage. More entire negative returns of the portfolio and little bit more is accounted for by just these 4 or 5 names. And the irony is these are solid businesses, global capability businesses, barring Metropolis, which is a domestic business. All the other businesses are globally proven, successful businesses with solid balance sheets, debt-free balance sheets, outstanding long-term record of value creation, and yet we have seen unbelievable drops in these high-quality names. So these accounts for entire negative result of the year, but actually more. The third I mentioned, names like Bajaj Finance, Finserv, businesses have done well, but the market returns have been negative, not to our liking, but that has happened. Fourth has been category of names, and there have been actually many. In a portfolio of 23, 24 names, we have seen almost 15 or 16 names have delivered positive returns in 22. And almost 11 names have done better than the market, and yet with the erosion suffered on the others, the net returns have been unfortunate. But we are watching, we are carefully assessing. We are not resting on our laurel. We are agile bunch of people, but we don't want to react in a narrow way, short-term way. We want to ensure compliance with our long-term value compounding and philosophy, and we remain deeply committed to it, but without any complacency or rigidness. We are every day we are putting day in day out effort to see whether there are any mistakes, there are any weaknesses, there are any flaws in any of our portfolios that needs to be corrected, and we are addressing. Candidly, I can make only one comment, and again, you may have to take my word for it, but I would not say that we made any blunder or some faux pas. We've been doing our work as usual. Of course, we would have some share of our mistakes, something we could have disengaged little faster, earlier, something we could have done little differently. All this, of course, is a part of it, and we would have our own share of mistakes in that. But there is no blunder, there are no lapses, there is no discipline violation, there is no philosophical flirtation we have done. We are doing what we are doing. There are times when markets displease you. Even if you do right, you may seem like a victim. There are times when you make actually not very good judgments and rather mistakes, but markets surprisingly may reward you that time. I don't want to justify 2022 with either. All I'm saying is there are periods when even if you do right things, you may not find gratifying outcomes for a length of time. So markets time to time hurt, they humiliate, and we with folded hands accept this humiliation, but we are watching, we are agile, and we are doing everything that we remain committed to. Our commitment to two objectives remains steadfast. One, on a long term, without the help of Mr. Market and its moods, we remain committed to absolute, healthy, positive absolute return compounded over long period of time. Second, we remain committed to is when we remain focused on the purity of absolute investing. Relative superiority of returns also is a byproduct, automatically will come, but we remain accountable for that as well over a period of time. Therefore, healthy absolute returns, relative superior returns, both remain our karma bhumi, our objectives, and we remain deeply committed to that. 1 year can be rough, and when one bad year is there, it will affect even earlier period, 2 year, 3 year numbers, and it may make it look as if a long period of sufferance. But in Indian entrepreneurial portfolio, which has just finished 13 years in January, in 13 years after 2012, 2022 is the second year when it has underperformed the benchmarks. Only second year in 13 years. Growth, which is our 21-year-old portfolio, 2022 happens to be fourth year of underperformance in 21 years. So every such experience is humbling, but in any long investing journey, some rudeness or injustice or our own share of some mistakes is something that we have to suffer. But net, through that journey, the results will be as I mentioned to you.
Bharat, thank you so much for your time
Thank you,
and
everybody.
giving confidence to everybody. We'll see again with you next quarter.